All right, what's happening, people? In today's episode of the Creative Acquisitions Podcast, I am going to talk a little bit about the first property that I bought inside of a partnership. And this whole episode is going to be focused on how we started, how we bought the deal, what kind of loans did we use, how much money did we put down, why was it a partnership, all these different things that are relevant for somebody who wants to get into the short-term rental space. And the one thing I will tell you is that good problems lead to good solutions, and good solutions lead to good problems. And what do I mean by that? When you have a business that is relatively successful, let's say it's a marketing company or a consulting company or a roofing company, and you have some of this excess cash, there's always this process that people go through, right? This process of like, okay, well, what can I do next with my money? I have some taxes, I got some payroll, I got to pay myself, maybe some retirement. There's this whole like flow of things that you can do with your money. And what a lot of people miss out on is they go from income to higher income, which leads to obviously more tax, but your actual net take home is a higher amount of money. And then what they do is they go take that money and they go spend it on generally liabilities, not always, but generally liabilities. And liabilities, we include things like crazy nice clothing or really expensive cars or things that are going to basically delete cash from your bank account every single month. Now, that's not a problem when you are continuing to grow the business and you feel really good about the whole process and you're just scaling up, scaling up, scaling up. Where that can become a problem, though, in my opinion, is when you are 5 years down the road in the business and you basically have nothing else you can do to optimize your wealth because you've taken all that cash. Let's say you've made $500,000 a year and you've spent all $500,000 when instead you could have taken $100,000 every year and put it into a property. At the end of 5 or 10 years, you could have had 5 or 10 properties, but instead you have 0 properties, which means you have no appreciation, you got no tax benefit, you got no cash flow, you built no equity, you didn't pay down any mortgage. And so the trajectory, right, the trajectory between individuals who buy a house every year versus individuals who do not buy a house every year is very, very different. So the roadmap that I would recommend, if you're a business owner or W-2 and you make over $400,000 or $500,000 a year, what I would recommend is that you earmark at least $100,000 every year from your income and consider it like an expense. Consider your investing like an expense. And the reason I say that is because a lot of people look at these strategies and say, okay, well, you know, I could use this money now, or I need this money for my tax bill, or I need to do my 401k. Like 401k is fine. Roth 401k is fine. Roth IRA is fine. All these other, SEPs, if those apply to you, all these investing strategies are good, including life insurance, right? What the problem really ultimately becomes is you can't spend all of your money and then try to buy real estate at the end. So every year, the first $100,000 that comes in should be put in a bank account and wait there for the deal that you're going to look for. And in my opinion, I would be looking at deals as early in the calendar year as possible. And here's why. Towards the end of a calendar year, what a lot of people try to do is they try to rush buying deals. So their inspections don't go as good as they should. Their appraisals don't go as good as they should. They are rushing the timeline. Their lender's getting stressed out. Their bank accounts don't look as good. Maybe they don't have as much cash on hand as they would like. There's so many things downstream that are going to be a huge issue. And so you end up making bad decisions. And so I'm going to talk a little bit about the first property that I bought with a partner in 2021. It was bought in November of 2021, which is towards the end of the year. We started this process in about September, but we had to go, it was a flip and had to go through multiple inspections and things like that. First thing to note was we bought it in Charlotte, North Carolina. And one thing that I would absolutely recommend that you consider is not buying in North Carolina to start. North Carolina has a due diligence money and an earnest money, okay? Earnest money deposit is typically you put down 1% of the purchase price, you get to do your inspection. If you want to back out, you back out, no problem. In North Carolina, they have due diligence money, and due diligence money is money that you put down that's immediately non-refundable regardless of what happens. And in our case, it was about $10,000. Because it was $10,000, what happened is we were buying from somebody who flipped the property. So they bought the property for probably $200,000, put $100,000 in to flip it, and tried to sell it to us at $415,000. We ended up closing on the house, I think, at around $404,000 if you check the MLS. And It's a great property. It really is. It's a 3-bed, 2-bath in Charlotte, North Carolina. It's a property that's a single floor, no basement, and it's a great looking place. Now, the thing that's really tough about having partners is you got to figure out how to structure a partnership arrangement that makes sense. Who's doing the work? Who's doing the money? What are the responsibilities before you close? What are the responsibilities after you close? There's all these things that have to go on, and in a partnership, it's always more complicated because you have to have that conversation with a partner. If you're just buying a house on your own, yeah, you might have a bunch of different decisions, but it's you making the decisions, and you just make the decisions. In an ideal scenario, your first property you buy, I think you should buy it in a partnership with somebody else. Yes, the decision making is more challenging. Yes, it could be more difficult to do. But when you buy properties and you have something go wrong, you're diversifying your risk by having two people. Let's say you have a $5,000 expense that comes up and you're like, oh man, I don't want to have a $5,000 expense. Well, if you have two of you, now it's a $2,500 and $2,500 expense. Yes, your upside is less, right? You're getting half the appreciation, half the mortgage pay down. You're getting half the equity, half the cash flow, half the depreciation, but you're diversifying your risk. And so in my particular situation, I really think that it's good when you start to have that risk mitigation because your first deal is never going to be your best deal, or really shouldn't be your best deal. We were very fortunate in the situation that property dollar for dollar on appreciation is one of the best properties out there. We bought it for about $400,000. We bought it with a second home loan because the other partner I work with, he really wanted to do that. And so we ended up putting $40,000 down plus closing costs, probably about $50,000 plus an extra $20,000 in furniture. So about $70,000 down on a $400,000 house all in. And with that, the house today is worth very, very close to $480,000. So we've gotten about $75,000 worth of value, and we have $70,000 in. So we have 100% return on our down payment by waiting 3, almost 4 years. Now, at the same time, we got a very low interest rate. I think the interest rate was like 3.75 or 4%. This was the bank loan. We put 20% down, did a DSCR loan, did the whole process, and that part was super, super easy to do, okay? Now, the problem that we have with this property today, the main problem that we have, okay, is that the property's performance is never really going to get significantly better. It generates between $60,000 and $70,000 per year, $67,000 per year, so call it $5,000 a month. The mortgage, principal, interest, taxes, and insurance, the full escrow payment is about $2,000. So $5,000 comes in, $2,000 goes out. We send about $1,000 out in cleaning, so we're left with $2,000. Another $500 in co-hosting and support team, and we're left with about $1,500. Now, $1,500 cash flow on a property is phenomenal. However, we've had to continuously improve the property, so all that money, all that $1,500 has gone back on the property every single month, with the exception of maybe $500. So we probably profit on that property $6,000 per year net, and the other property in that same partnership we have that's also in Charlotte, North Carolina, probably about $6,000 a year in profit. Now, that's cash flow profit, okay? That's not including the mortgage pay down. These mortgages get paid down about $400 or $500 per month, each of them, because they have a very low interest rate. So we're getting about $6,000 a year in cash flow on each property. We're getting about $6,000 a year in, we're getting $6,000 in cash flow. We're getting $6,000 a year in mortgage pay down across 2 different properties, right? So it's 12 on one side, 12 on the other. It's a partnership, so we're each getting 6. Now, we're not taking any cash out because there's no need to take any cash out because that's not what we're living on. But this property will be a property that's worth probably, by 2030 will be worth $700,000. By 2040, probably be worth $1 million, the property, right, with inflation. It's hard to believe that. Anyone who's looking back at any property ever probably is going to say, wow, that, I was not expecting that property to do that well. But, it just kind of is what it is. So this property, again, it's a 3-bed, 2-bath, single floor, $404,000, 10% down plus closing costs. It's a great deal, but the thing that you have to keep in mind is that every deal is good for different reasons. You will either get one of 2 things. You will either get cash flow or appreciation. You'll rarely get both. And here's a great example. In Section 8 housing, Section 8 housing, extremely good market for cash flow. It's high, stable rents that come in every single month with long-term tenants. CapEx can be high, but it's stable cash flow. Now, what the problem is with a Section 8 house is you get zero appreciation. You buy a $100,000 house, and in 10 years is worth $100,000, right? And I'm being somewhat facetious here, but at the same time, like you got to realize that you can't have both. You can't have $500 to $1,000 to $2,000 in cash flow and get massive appreciation unless you're in much larger properties, and those larger properties you can work on as time goes on, but you can't work on larger properties up front. So if you buy in Asheville, North Carolina, an $800,000 house and put tons of money into it and improve it, you can get $2,000 to $3,000 a month in cash flow, and you can get $30,000 to $40,000 a year in appreciation. That is possible. But again, for entering into the short-term rental space, that is a totally impractical way to start. And again, the goal, as a reminder, is from 30 to 60 years old, buy one home per year, which is 30 homes. By the time you bought your 30th home, the first one's paid off. And then as you go into retirement, they get paid off more and more and more, which means you can liquidate them. So you build assets on the way up, liquidate them out on the way back down, okay? Now, the best thing is time. Time is going to solve all those problems because you're going to get the appreciation, the value is going to be going up, and the mortgage is getting it paid down. But that 30-year plan, you got to start. Now, if you're not 30 years old, which 99% of the people who watch this video are not going to be 30 years old, you might start at 35 or 40, okay? And if you start at 35 or 40, you are going to have to go till you're 65 or 70, which is not a problem at all because people are living extremely long. The point of this episode is for me to talk to you about how the very first deal was. It wasn't an amazing house. It's a 3-bed, 2-bath. It wasn't a gazillion dollars. It was $400,000. It was turnkey. It was post-flip, right? Somebody had flipped it, so it's in good condition. It was not a burr. It was not a fix and flip for us, but it was a flip for somebody else, right? They came in, they bought the house, they modified the house, and sold us the house. There are great ways to make money doing that. Now, another thing to keep in mind, and this is just a general real estate concept on value. If you look at transaction from one person owning the house to the second person owning the house to the third person owning that same house, there is a value transfer every time you move homes, okay, or you sell a house. So if somebody buys a house for $200,000 and they put in $100,000 to rehab it, so you're in for $300,000, and then they sell it to you for $400,000 for a $100,000 profit, that would be a very high profit. But let's just say they did that, okay? All of that equity is going to be squeezed out. All right. So you have to keep in mind that the house that we bought, there was a lot of that equity that was forced appreciation. They bought a crappy asset, improved the asset, and sold at a fair market value. Now that whole market, the whole CMA market, comparable market approach, right? The whole neighborhood has gone up in value because of this one sale. Because most of those homes are $300,000 and this one sold for $400,000. So now all those homes you're seeing $350,000, $375,000, $400,000, $450,000. They've all gone up slowly over the last 3 or 4 years. And the craziest part about this whole thing is you ultimately have a house now that's in a stable market with a 30-year fixed mortgage that we're whatever it is 4 years into, that the mortgage is the same every month. The principal pay down is getting bigger because there's less interest and more principal every month. It's an easy asset to manage. It doesn't have a lot of stuff that goes wrong. It's a small house. It's quaint. It's easy to run. It's a good property. Okay. Smaller homes can do really well, but they're not going to throw off a lot of dollar cash flow. Percentage cash flow, yes, may be very, very good, right? $500 on $5,000 in revenue is quite good, right? Because that's about 10%. So the percentage cash flow is really good, or the percentage cash on cash return can be really good, but the actual dollars per home is small. $500, you'd need 20 of those homes to make a reasonable lifestyle, right? And so the goal is not really financial independence through buying real estate. It's a supplement to retirement. So the way that I look at, personally, the way that I look at all the short-term rentals, and really any real estate investing, is if you get cash flow, great, but we're not going to count for cash flow. We're going to assume that we lose money or break even every month. So the only thing we're relying on is two things, really. The appreciation, which we know is going to be 3 to 5% per year on the full asset, right? And the mortgage pay down, right, which is going to be about 2% a year in the beginning, right? Because if you think about a value of an asset divided by 30 years, it's about 3.5%. But in the beginning of the mortgage, there's a lot of interest. So you're paying down only a smaller portion. So about 2% of the value of the house. Okay. So from a strategic standpoint, you have to ask yourself, What do you want to do? Do you want to buy assets and store money in assets? Are you trying to cash flow? Are you trying to run it as a business? Are you trying to run a management? What are you actually trying to do? And I think what you will find is that the best strategy is buy 30 homes over 30 years that are in your price point that you can afford the down payment on. In an ideal scenario, I'd have $100,000 down per home if you're making $400,000 or $500,000 a year. And if you're not making $400,000 or $500,000 a year, you might have to dial that number down a little bit. Now, with that $100,000, what are you going to do, right? You're going to use some of that for a down payment, some of that for furnishing, some for closing cost, and some for carry costs, okay? And remember, carry costs is the cash that you deposit in the bank the day you close to be able to carry the property. Every single property will lose money for 6 months at least. I promise you, you're not going to walk out of the door and make money on day one. It's never happening. I promise you it's never happening. You're going to get smoked, okay? And so this is very, very important. If you don't understand this concept, what you're going to end up is you're going to buy homes too quickly, and then you're going to have a liquidity issue. Now, in some instances too, you can talk about compliance, right? Buying the right short-term rental in the right area. Along my short-term rental journey, I bought 3 homes that were not permitted appropriately. One was a 6-month stay, one with 2 or 30-day stays. Misled by a real estate agent, significantly difficult time, and was kind of early on in the journey of trusting a new person to help us do this process. Today, we have a person that we rely on to do compliance, to cross-check the work of agents and sellers to make sure you're good. Because just because somebody's running a short-term rental doesn't mean that it's going to continue to run as a short-term rental, which is a massive issue. So what I like to do is just say, okay, here's what's going to happen. We're going to do X, Y, Z, right? That process. And first step is find the house, then underwrite the house, build the pro forma, do the compliance check, do all the steps, and you got to do it in order, and you can never miss the compliance step, because if you miss the compliance step, you're going to be screwed. So back to the first home, right? Charlotte, I would recommend you buy something in that kind of price point today. Something around $400,000 or $500,000 to start is a good place. If you want to go $700,000, $800,000, $900,000, that's fine. If you can swing that, you can do a second home loan, you could DSCR, you can do a bank statement loan, you can do seller financing, you can do wraparounds. There's a million ways to acquire it, but just make sure that you don't consume 100% of the cash that you are using, right? Like if you have $100,000, do not put $100,000 down. Put $70,000 down, put 15 into furniture, and have 15 in carry cost or something like that. Okay, please, please, please do not deplete all your cash. On top of that, think about your mortgage paying down the mortgage as a deposit into like your 401k every month, right? So you're depositing $500 a month into the 401k, boom, 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 every month, right? When you're making mortgage payments. So not only, even if you don't get cash flow, you could get zero cash flow forever. That pay down of that mortgage is depositing equity into the property, which is always there. It's not as liquid as something like a money market fund, but again, that I'm just giving an example of that is making a deposit into your future. The best case scenario is that you can have 20 years, ideally 30 years, but 20 years will do it, of appreciation. So you can at least double everything twice, right? Now, if you are struggling to get started in this space, I would find somebody else who's in business or has a similar job to you that has similar income to you. So you can go 50-50 on the down payment to start. That will diversify your risk, get you into smaller property. One of the two of you can take the loan. There are some loan requirements on that. If you do seller financing, they don't care about any of that. And buy a property. It's December right now. You got 20 days left in the year. Please buy a property. Even if you don't think this is going to be the year for you, please buy a property. It's going to make things so much easier for you, okay? Get a subscription to Price Labs or AirDNA or whatever tool you like. Underwrite the deal. Build yourself a pro forma. Do all the steps properly, do compliance checks, and then purchase your first deal. It doesn't have to be a slam dunk home run. Hit the singles, please. Just hit a normal property and start building up assets. Do not worry about trying to go to the moon. Thank you so much for watching, and we'll see you in the next episode.